Are you concerned about higher taxes? I'm Craig Kirsner, president of Kirsner Wealth Management. We talked about contributing to IRAs and 401ks in another video, which are ways to help either defer taxes till you're in a lower tax bracket or not pay taxes on your investment gains at all with Roth IRAs. If you're concerned that taxes will increase in the coming years, one of the strategies is that you can put in place is to do Roth IRA conversions. If you have a traditional IRA, you're allowed to convert those funds from pre-tax dollars to a Roth IRA where you will eventually withdraw that money tax-free. In converting the funds from traditional to Roth, you avoid penalty, but you're responsible for paying income tax. For example, if you were to convert $10,000, you would add that $10,000 to your income and pay income tax in whatever bracket you're in now. Outside Roth conversions and maximizing contributions to tax-favorable accounts like IRAs and 401ks, there are other options in tax-favorable accounts using annuity products to defer taxes on gains. So now I'm very pleased to bring up our Vice President, Sean Burke, to discuss this further with you.
Hi, I'm Sean Burke, Vice President. Another strategy that you could implement is something within your money management called tax loss harvesting. What this means is that you can create opportune losses throughout the year in order to offset gains and reduce tax liability. When done properly, you're able to reduce the taxes by reducing the taxable gains without missing out on participating in the portfolio's gains. This can be a complicated concept or strategy, and we recommend you consult a financial professional in regards to implementing this. Within your money management strategy, for money that's not in an IRA, you could use municipal bonds, which are tax-free. There are two types of municipal bonds, general obligation bonds and revenue bonds. You can think of bonds like a loan, where you're giving the municipality a loan, and in return, they're paying you interest for a certain period, and then you get your principal returned. General obligation bonds are backed by taxes, and revenue bonds are backed by the infrastructure project. Think of a highway that generates revenue through tolls, and money is paid back to you, the bondholder. Most of the time, it does not make sense for you to use municipal bonds within an IRA and never a Roth IRA, because you're already getting the tax benefits from an IRA, so there's no additional advantage. An additional item to be conscious of in regards to taxes is owning mutual funds. Although mutual funds make diversifying and managing your money easier due to being able to contract the responsibility out to the fund manager, mutual funds give distributions at year-end, which are taxable if not in an IRA. These distributions can cause unintended tax consequences, especially if you have not owned the fund for the full year. If you haven't owned the fund for the full year, you will be paying taxes on a distribution of gains that you did not participate in. To learn more about retirement planning designed to preserve and help protect your wealth and leave a legacy, you can attend one of our upcoming complimentary dinner workshops at Ruth Chris or Abe and Louie's Steakhouse in Boca Raton or Fort Lauderdale. This workshop is best suited for those over 65 with a net worth of $1 million to $10 million or more. If you live outside of South Florida, call us to set up a Zoom meeting with Craig Kirsner and myself. Call our office and register now at 1-800-807-5558, 1-800-807-5558.